Italy's economy is like a tangled mess, a mix of problems most countries face, all hitting at once. It has the fourth largest public debt in the world. Its population is aging and young talent is leaving. There's also a big gap between rich and poor regions, slow economic growth, and taxes that aren't bringing in enough money.
Decades, our nation has experienced an unprecedented social and economic decline.
On top of that, Italy used to be a top player in industries worldwide, but now it's struggling to compete. Well, these issues aren't new for Italy. They've been around for at least 20 years, contributing to its economic decline for the past 15 years. Today, Italy's GDP is a staggering 15% lower than it was in 2008, and this decline has led to high poverty rates compared to other European countries. So how did one of the fastest growing economies suddenly stop growing? And who's really to blame for all this economic mess? If we cast our minds back, we'll find that Italy's economy hit its peak in 2008. But since then, it's mostly been stuck in a rut. Over the past decade, it's lost about 20% of its economic output. But if we take a step back and look at Italy's history, we see this isn't anything new. Historical patterns reveal a fascinating cycle. Periods of slowdown are often followed by remarkable bursts of growth. After World War II, Italy rebuilt itself, often from rubble, with help from the USA through programs like the Marshall Plan. The USA invested a lot to rebuild Western Europe, partly to create new markets for American goods and partly to strengthen allies against communism. This rebuilding effort led to a long period of growth, but there were also serious political tensions, like the bombing of the Bologna railway station in 1980. These tensions intertwined with economic problems. Although Italy seemed economically strong due to high output figures, much of this growth came from taking on debt for development projects, especially with support from powerful countries to counter communism. The real challenge lay in sustaining this growth and creating value for the economy beyond construction. When construction slowed and funding dried up, Italy entered its first modern period of stagnation, lasting about 6 years. This brought mass unemployment, high debt, inflation, and rising energy costs. However, economic slowdowns can prompt policy changes. Italy restructured away from infrastructure projects and focused on producing goods for global markets. Reforms included granting independence to the central bank and relaxing laws on wage indexation. Wage indexation means wages keep up with inflation, but it can accelerate inflation further through a process called the wage price spiral. Despite the pain of stagnation, Italy bounced back as one of the world's fastest growing economies. Between 1985 and 1992, it tripled its economic output through an export-led industrial boom. Italy's reputation for high-quality craftsmanship gave its exports a premium appeal. Whether it's fancy cars, designer bags, or even olive oil, Italian-made products are seen as top-notch. This means that even if a similar product from another country is cheaper, many consumers still prefer the Italian version and are willing to pay extra for it. Not many countries can boast this kind of reputation, so it's a big deal for Italy. However, Italy's good times didn't last forever. As the economy grew rapidly, problems started to crop up. Debt began to rise again, and both the government and people borrowed recklessly, expecting even more growth in the future. Tax avoidance became a widespread issue, especially among the small businesses driving Italy's export success. These businesses found ways to avoid paying taxes, taking advantage of the weak government oversight and loopholes in the system. In a way, the government's approach mirrored a classic strategy of economic expansion: lower taxes, fewer regulations, and more spending. This was probably necessary to kickstart Italy's economy in the 1980s. But when Italy joined the Eurozone and adopted the euro, it had to clean up its act. It had to reduce its debt and make sure people paid their taxes properly. This meant more rules, less debt, and higher taxes, which took money out of the economy and slowed down growth, even though it was the right thing to do. During the 1990s, Italy's economy got stuck again, almost like it was frozen in time for about 10 years. Luckily, when Italy started using the euro in 1999, it had a chance to grow again, and grow it did. Its economy more than doubled in less than 10 years, making it one of the fastest growing economies in the world again. Joining the Eurozone made it easier for Italy to get investment from other countries, attract foreign workers, and sell its products abroad without worrying about currency exchange problems. Plus, industries like manufacturing and tourism started to boom. But then came the global financial crisis and the Eurozone crisis, and Italy got hit hard. Since then, it's been stuck in another period of slow growth for almost 15 years. So, are we on the brink of witnessing yet another Italian economic renaissance? It's hard to predict, but if history repeats itself, Italy might be due for another economic upswing. However, it's not that simple. One major change is Italy's aging population. Many workers are nearing retirement age, and there aren't enough young people joining the workforce to replace them. This issue is worsened by Italy's low birth rate and the high number of young graduates leaving the country for better job opportunities elsewhere. But there are a couple ways to look at it. From an individual standpoint, having the freedom to move around for work is great. It gives people the chance to build a better life and share their skills wherever they're needed. But from a country's perspective, losing talented workers can hurt, especially when those workers are heading to places with better opportunities like Germany or France. And with the European Union, it's even easier for people to move between member countries. To keep skilled young Italians from leaving, Italy could raise wages. But the problem is that Italian industries aren't as productive as those in other European countries. Italian businesses tend to be smaller, with fewer employees. In industries like car manufacturing, bigger companies can make more specialized and valuable products. Italy also lags behind in technology. Things like computers have made workers more efficient, but Italian companies haven't embraced these advancements like other countries have. This affects not only their productivity, but also their ability to compete globally. Italy's economy is facing many challenges: high unemployment, slow growth, an aging population, uncompetitive industries, and high debt. Trying to fix these problems is tricky. If Italy raises taxes or borrows more money, it could make things worse. Despite all this, Italy's economy is still a big deal. Together with Germany and France, it makes up more than half of the European Union's economy, which is the second largest in the world. But the twist is, Italy's economy might actually be even bigger than official numbers show. That's because a big chunk of economic activity operates in the black market, meaning it's off the record and not taxed or regulated like it should be. This hurts the economy by reducing tax revenue and causing social problems. Economists usually assume things will get better over time, but that's not guaranteed. Italy is just one of many advanced economies struggling to compete globally. Despite enjoying growth for a long time, the future isn't certain. But if history has taught us anything, it's that Italy has a knack for defying expectations. With its breathtaking landscapes, vibrant cities, and a strategic geographical position that's the envy of many, Italy possesses the ingredients for success. Do you think Italy's economy will bounce back once again? Share your thoughts in the comments below, and subscribe for more in-depth explorations of fascinating economies.